Do you want to find the safest stocks with the highest return? Because that's what we're gonna do in this video. And do you remember how we gonna do this? Yeah, math. Ladies and gentlemen, welcome back to another episode. So I heard you want low risk and high return. I can't blame you, who wouldn't? But how is risk measured? How do we know if a stock offers better reward per risk than some other stock? We're going to see how these questions led to the creation of funds, in particular index funds. By the end of this video, you will know the following things: how to increase gains and decrease risk, why you have to buy an index fund if you don't know how to invest, how to create the best index fund in a way that is mathematically provable that it is the best. And if you leave a comment below with your stocks, I'm going to plug them in, show you your risk profile, and you will see how index funds are created and why. Lastly, I will simulate how change in interest rates affects stocks. Now, you don't need to be Warren Buffett, but you can still invest successfully. It's easier to buy one fund than manage 1,500 investments, though you have to pay a fee for it. And now make sure to subscribe if you're serious about investing successfully. And let's hit it! Welcome back. My name is Adrian. I'm an engineer and I used to work for a market maker in algo trading. In the last video, we talked about various types of funds, so you know which ones are good and which ones are better, and how much money you're losing if you invest in the wrong funds. For that video, just click here. Now I want to explain why an index fund is the best you can get. You don't need any insider knowledge. You don't need to be smart. You don't need to be Warren Buffett. For the amount of work that you have to do, an index fund is a pretty good payout. So we want low risk and high returns. But what is risk? For this video, I measure risk as a spreading of returns. Because life is short and you're not going to watch a 2-hour video on risk. But for $99.99, you can get a full video. Just kidding. I made around 10,000 trades in both 2018 and 2019. And when I plot the return for each trade, I get these two distributions. I made the same amount of money in both years, but in 2018, I took more risk. I can say this because the orange distribution is more spread out, and more spread out means more risk. You can see I have a couple of trades that were losers, where the returns are below zero. A couple between 0 and 10% return, most between 10 to 30% return. For comparison, if I want to see how risky in this context long-term US government bonds that pay 5% interest are, I can add those to the chart and compare it to my own returns. And that's this red line here. There is no spread because the government will always pay until it defaults or debt is restructured, but that's a story for another time. So they have virtually zero risk. That's why you see one bar and there's no spread. I'm going to show you how you can move from the yellow curve to the blue one. The short answer is diversification, but how? In this video, I will answer only a part of this question. Diversification among stocks. But first, why should you believe those people who say that diversification helps? What if they're part of lamestream media? Do you trust just anyone on YouTube with no proof? If you do, well, I got something to sell you. My 5 secret investment strategy that will make you a millionaire in under 1 year. It costs only $999,999,999. You may know that one of the reasons why index funds were created is diversification. There are other reasons as well. Now, unless you have a team of researchers or insider knowledge, you can't put all your money into Tesla at the right time and quadruple it. If you do, just, call me. We'll work together. Let's start with the average Joe approach and improve on it. Let's pick 2 stocks at random, Baba and Tesla. They're pretty popular these days. I'm going to calculate their risk and return. And I'm going to make some assumptions here. These are that a normal investor like you and me, we're logical investors. We prefer low risk and high return. There are also dumbass investors that don't care about these things. In fact, some of us may want the highest return per risk, while others prefer the safest return per risk. And I will explain these later. In this example, I'm going to look at one way to measure risk. But you can have many other risk variables in here, not just one, like in this example. So let's look at the daily returns for BABA and Tesla and annualize them. So here we are. The x-axis shows increasing risk from left to right, and y-axis shows a return or value, bottom to top. So you have to be in the top left corner, right here, where you have the highest return and no risk, ideally. In real life, that's not really possible. Now, if you wanted to make your own fund with these stocks, how would you do it? Well, you could use 1% of your money to buy Tesla and 99% to buy BABA. Let's see. Or you could put 2% of your money in Tesla, 98% in BABA, 3%, 97%, and so on. And you have this table, basically, of all the possible combinations of weights. So basically, you decrease your allocation to one stock and increase it to the other. And that's how you generate all the possible combination. Now, the thing is, you could also use decimal point here, and you can see how that blows up. And you can get infinitely many possible percentage weights to create your fund. But practically, thousands is quite enough for us. Oh, and by the way, you can have negative weights, which means short Tesla to buy BABA or the other way around. Let's start with two stocks and see how we can combine them to make a fund. Here are three possible allocations for your fund with 20% BABA, 80 Tesla, 66% and 34%, and finally 88 and 12%. And here are some more. The question is, what allocation will give you the best return per risk taken? Is it 1% Tesla, 99% BABA, or 56.88% Tesla and 43.12 BABA, or some other allocation? Is there perhaps a combination that's better than all others? In order to answer this, I'm just going to calculate all percentage weights for all possible funds I can make with these two stocks. And here they are. All possible funds make up this line. Let me add some color based on best reward per risk, also known as Sharpe ratio, and we get this chart. Higher values are better. Risk decreases as we go down. For two stocks, that was pretty easy. I can brute force it. But what fund has two stocks? What do I do for three stocks? What about 100 stocks? And it gets hairy really fast. Let's see what happens when we have three stocks in our fund. And I'm going to throw in Facebook, so Tesla, BABA, Facebook. Here are 5 possible funds that we can make with these 3 stocks if we give different weights to each stock. That doesn't tell me much, so let's add more. Here are 100 funds that we can make with these 3 stocks. Here are 500 funds that we can make. And this is starting to look interesting, so let's add more. So finally, 500 possible funds to pick from. I think this looks more interesting than any 2-stock fund. So all of these dots form this nice green graph. It's like a grass field. You can hit pause here and see where you think the most riskless combination is. Let's overlay this with the graph that we can create from only 2 stocks that we saw earlier. This is a special case because it matches the top of the greenfield graph. This means that adding Facebook as a 3rd stock didn't change the risk profile very much. Let me explain. If we're looking for the safest return, the least amount of risk, that's this point on the chart, the tip. So we've certainly improved risk by adding a 3rd stock because the tip moved to the left. Notice that there are multiple combinations of weights that create a fund with the same risk profile. This is interesting. I can pick different weights of the same 3 stocks and get different returns for the same amount of risk. Would you pick more returns or less returns? The risk is the same, so the logical answer is to pick the highest return you can get. Let me ask you this. If you had to jump in a cold lake, and I ask you to pick your reward from a choice of ice cream or $1 million, is there ever a time you would pick the ice cream? No, it makes no sense. With $1 million, you can get a lot of ice cream. You can even buy an ice cream machine. In fact, for any risk in this chart, I prefer the highest return. I don't even care about lower return. I want the highest return I can get for the risk I take, for each of these risk values on the x-axis. So this means we care only about the weights in these funds at the top. I think this graph is a little unexpected and interesting. So there are a lot of bad funds that you can construct if you hilly-billy buy stocks. Here we narrow down the list to a couple of good ones. Well, I did all the work, but we'll share credit. But still, there are too many to pick from, so I had to do more work and see if I can find the very, very best one, or at least narrow down to 5 that we can analyze better. Now, the best fund can mean many things to many people, but 2 of the most common meanings are when the weights give you the lowest risk and when they give you the highest return per risk taken. For example, if you retire, the best fund is one that has low risk. If you're in the accumulating phase, you can afford more risk to get more growth. First, let me draw the line at the top, indicating the funds for which we want to know the weights. We care about the funds that start at the tip and go all the way up on the red line. You don't want to go under the tip and get low return for the same risk as a higher return fund. It's not logical. And this red line is known as the minimum variance boundary nomenclature. And the efficient frontier is the part of this minimum variance boundary that starts at the tip and goes upwards. So my legend is a little bit wrong here. So we want the combinations of stocks in our fund that lie on this line from the tip upwards. So I'm going to remove the other possible weights and show you only the minimum variance boundary, but keep in mind you don't want to go below the tip. So back to narrowing down the list of funds. I want to find the safest fund or index fund that I can build. This is for more risk-averse individuals, and that is the tip of this outline. I would also like to find the best bang for the buck index fund that I can create. So let's find these out. It would take a little longer to explain why Max Sharpe is the best return on risk. So if you leave a comment, I'll do a video on that next time. Just let me know. Also, if you want me to plug in your stocks and show you your risk profile, leave a comment below with your stocks and I'll get back to you. We'll figure something out. I'll probably do another video with all of these. Now we want to know what the percentages are for these two funds so that we can create them. And in this case, because you only have 3 stocks, you can see that if you have 8% BABA and 60% Facebook, you'll get maximum return per risk. And if you do 50-50 Facebook Tesla, you get a minimum risk fund. This is a great accomplishment already. From a list of stocks, we can figure out how much to buy of each to achieve the risk we want. Now, I also like to look at correlations. And in this case, it doesn't help us because we only have, 3 stocks. But as we add more, this will become more useful. So here's the correlation. But I still haven't shown you how many stocks to hold in the fund that you're making. Perhaps this is a perfect number for minimum risk and something for maximum return per risk. What I would like to know is how many stocks I should put in my fund. If it's a lot of them, maybe I should buy a similar enough fund that already exists. So let's look at that next. I will keep adding stocks to our fund and plot the frontier and see if risk reward improves. And by frontier, I mean the minimum variance boundary. So here's a list of these funds. We start with BABA, Facebook, Tesla, and then we add a couple more things and a couple more things and more and more and more. And eventually we end up with 59 stocks. The maximum Sharpe ratio, which measures return per risk, is increasing as we add more stocks. Minimum risk is also decreasing. So far it looks promising. Let's take a look at what the frontiers look like. We start here with an inner shell, this dark blue line, which was Tesla, BABA, Facebook, if you remember from before. When we add 3 more stocks, we get a green line, which moved to the left, decreasing risk, and also moved higher, increasing reward per risk. As we add more stocks, the line is moving to the left, reducing risk further, and it also brings the top more to the left, giving better return for risk. Look at this. For the same risk that we get 18% return with our initial stocks, we can now get 24.3% return with 59 stocks, or 21.7% with 21 stocks, or 20.8% with 12 stocks, and so on. The more stocks I add, the more the fund's risk-reward profile improves. That is, the line moves up and to the left, which is the best place to be, really, at the top left. So we can reason that the more stocks you add, the better the risk profile, and that's how you get indices. An index lies somewhere along the line, usually at max Sharpe ratio. And speaking of Sharpe ratio, let's look at what the Sharpe ratios and minimum variances look like for all these funds that we created. But you can look at the 2 interesting funds, minimum risk and maximum return per risk, and see if some index return is better than these, and then you can make an educated decision to go with the index if it is better than the fund you can create yourself. You also need to keep in mind that buying an index fund comes with fees. Some questions you should have at this point. Can we eliminate all risk if we add all stocks? I cannot prove this because my computer is not powerful enough to run simulation for thousands of stocks. But if we go back to our efficient frontiers chart, and we can see that from 21 to 59 stocks, the jump at the tip is not that large compared to how much it moved when we jump from 3 to 6 stocks. So I hypothesize that the more stocks we add, the more we seem to converge to some point at the tip. There will be an amount of stocks after which risk cannot be further reduced. We may be left with systematic risk, as in all stocks have some amount of risk which you cannot eliminate. Systematic risk can come down to liquidity, business cycle, credit, and so on. You can see the liquidity crunch in stocks during a market downturn. Rather, the downturn is because of the liquidity crunch. When we have a fund, a collection of investments, your return comes down to how the similar stocks move with respect to each other. The technical word is covariance among stocks. But if you want to look at a covariance matrix, this doesn't tell me anything. Just because covariance is 0, it doesn't mean that stocks are independent. So I find correlation matrix more useful. This one gives you an idea how the stocks are correlated, but it's very broad. I like to break it down even more, say weekly correlations, monthlies, dailies, and get a better idea how these stocks move. When you do any analysis on the data, you shouldn't include the last month. Just a tip. Oh, by the way, did you notice that in a downturn, all stocks move down together? They suddenly become highly correlated. So in another video, I will show you how we can still lower the risk profile of the fund that we started here. Do you ever wonder what happens to the frontier as interest rates change? Here's our fund of 3 stocks with 3 interest rates of 1%, which is today or not long ago. Pay attention to the color bar on the side. The range goes from 40 to 75. Now let's increase interest rates 10% so we can see the effect better.
Dies stand bei increasing interest rates.
The color has changed, though don't be fooled by the color. Look at the color bar on the second chart. The first chart goes from 75 to 40, the second chart starts at 40 and goes all the way to 10. Notice that as interest rates increase, the risk profile changes. It's riskier to hold stocks when interest rates increase. Sure, one could say in this scenario that you can get 10% return from bonds for virtually 0 risk, so holding a fund returning 18% with 28% risk is seen riskier than in a scenario where interest rates are 1%. This is not a law, it's because of the formula that we use in the calculations to define risk. Everything is relative. If you have created your own fund in order to eliminate the last of the fees of mutual funds, ETFs, or indices, and save at least $270, and you can see my previous video on how I found that number out, you should have something like this set up so you can run the simulations daily or weekly and rebalance to maintain the correct percentage weights. Why? Because correlations change. Banks run simulations like this every night, so they have fresh numbers to work with in the morning. More on rebalancing in a future video. Some other things you might want to check is to try it on old data, say 2010 to 2015, and see how well it predicts the market in 2016 to 2020. I want to leave you with one more thing. If somebody says, hey, give me your money, I will invest in this, or gives you advice, hey, you should invest in this, you'll make this much money, what you should do is show them the efficient frontier and politely ask them if they can beat it for the amount of risk that you're interested in. There are drawbacks to using the efficient frontier to create your portfolio, so you have to be aware of them. Correlations change all the time, so you have to periodically monitor this, and you have to know your investing time frame. Keep in mind that with this framework, past returns are used to determine the future. And remember that past returns are not an indication of future returns. I will make a whole new video on this related to how to know which ETFs will go up next. Determining optimum allocations using the efficient frontier require you to really know your risk and know where you stand. It's one thing to say in a bull market that you're willing to hold your investments through a downturn, and a totally different thing to actually go through the downturn when your emotions can make you leave a Hershey kiss in your underwear. Alright, that's it for this video. I always try to keep it short, but somehow I end up adding a lot more material and it becomes a lot longer video. And I still feel like I didn't add enough. Don't forget to leave a comment with your stocks and subscribe for more practical investing education. Ciao!